said, my name is Greg Favilevich. I head up the global funds group at Fitch Ratings. The funds team rates various types of funds, including money market funds and bond funds, and also fund finance instruments such as subscription facilities, NAV loans, CFOs, and rated feeders. This session will be an introduction to fund finance, given it's an emerging area. I'll give an overview of different types of products, key risks, and how Fitch addresses and analyzes them, and market developments affecting each of the various products. Now, first, to level set, what is fund finance? So fund finance essentially is a very broad category, but we can think of it as debt instruments that are used to finance exposures to private capital funds. Examples include subscription facilities, which are liquidity lines to private equity or private capital funds, NAV loans, which are structural asset-based leverage to the same funds, and then CFOs and rated feeders or rated note feeders, which are structured vehicles that are used for fundraising or liquidity for fund managers or for investors. Okay, and to provide some context, I'll just start with with a little bit of an overview of market developments in this market. So first, the fund finance market has grown significantly in the last few years and continues growing, and we expect it to continue growing further. So it's more than $1 trillion market now. We expect it to get to more than $2 trillion in the next couple of years. And what's driving the growth of this market? So a number of different things. One, it's the growth of private capital funds, private capital markets in general. So there are more funds being raised, and these funds are raising bigger, or the funds sizes are bigger than before. We've seen funds that are 20, 25, $30 billion in size. So really quite massive. As well as innovation in the type of products being offered in a fund finance market and broader adoption of these products. So, for example, subscription facilities are a product that's been in existence for a very long time, since the 90s, but initially it was relatively niche product that only a few funds use. Now it's fairly standard, and I would say most funds, whether private equity, private credit, or private infrastructure funds, for example, they use subscription facilities. So broader adoption of these products. We're seeing newer products emerging, such as NAV loans or CFOs or rated feeders. Those haven't been around as long to the same degree, but we're also seeing their greater adoption of these products. And finally, we've seen an entry of institutional investors into this market to provide the financing. So why does that happen? Why isn't institutional investors coming in? Well, really, it's to solve some of the problems that have popped up in a fund finance market from a supply-demand perspective. I talked about the growth of the demand side of this market. There's the more funds, bigger funds, more facilities being requested by the fund managers. Historically, banks have provided the financing for this market. They've provided the subscription facilities and the NAV loans. And banks just haven't been able to keep up with the demand that we're seeing in this market. Why is that? One, it's just the market has grown faster than banks have been able to keep up, just kind of naturally. But also there have been some changes in capital rules that affect banks' ability to provide these facilities. Essentially, it's become more expensive for banks from a capital perspective to finance these types of funds, or at least some of these types of facilities. Now, the industry has come up with a number of different solutions to try to close this supply-demand gap. One of them, as I mentioned, is to bring institutional investors into the market. However, some of the products historically have not been well suited for institutional investors. For example, subscription facilities, and I'll talk about it in a bit more detail, but they're revolving facilities. Institutional investors, for the most part, really have a hard time handling kind of same day or next day funding of revolvers. They prefer fully funded term tranches. And so we're seeing an evolution in the structure of some of these products. For example, subscription facilities being termed out into 1 or 2 year terms, sometimes longer, it could be 5 or 7 years. We're also seeing securitizations and SRTs, which are synthetic risk transfers. Essentially, also these are ways to take the historical product that's existed, pool it, and then have a note issued or a reference obligation that an institutional investor can buy into in a form that they're more familiar with. And then ratings themselves are also an innovation. I mentioned a few of these products have existed for a long time, but historically have not been rated. Now the institutional investors are coming into the market. We are seeing more demand for ratings to help these institutional investors with either their own capital requirements or risk assessment or liquidity or comparability. There are multiple reasons for the interest in the ratings. Another important factor to consider, important trend that's driving fund finance product innovation and product adoption is the slow fundraising environment. So we've seen in the last few years a relatively weaker M&A activity, fewer IPOs, and so that means that the fund managers are not providing as much distributions and liquidity to their existing investors. This means that if the investors are not getting cash in, they don't have as much cash to allocate to fund managers' new funds. And therefore, fund managers are having a harder time raising money for their next vintage funds. There are other reasons for that as well, but this is one of the key ones. Fund managers are making efforts to correct this issue or alleviate investor liquidity with innovation. So one of those items is continuation vehicles. So that's a way for a fund manager to move an asset from one fund to another fund. These are also often get financed under the fund finance umbrella. This provides liquidity to investors. NAV loans in some cases are also used to provide liquidity to investors. And so investors will be able to allocate more money to the manager's subsequent fund. Another way that managers are looking to address this liquidity issue is by structuring new types of products that make it easier for investors to commit to the funds, in particular insurance investors. So those are rated feeders and CFOs. A CFO, by the way, is a collateralized fund obligation. I'll explain in a bit more detail what that is in a minute. But essentially, there are ways for investors to, instead of commit directly into a fund, they will commit to a vehicle that issues debt and equity, and that improves the capital treatment for certain investors, for certain insurance investors, and just allows other investors to come in through a debt instrument into a fund rather than a more traditional equity route. That was the kind of background, the context of market developments. Here I have a quick overview of the fund finance products, just so you can see the scale of which products are kind of larger and which are smaller. So the larger segment is subscription facilities. So here it's 850 billion. Really, many of these markets are private, so it's quite difficult to put a precise figure on the size. We actually think the size of the subscription finance market is greater than $1 trillion today. Maybe somewhere in the range of 1.2 trillion, but some estimates in the market say it's up to 1.5 trillion. So there's quite a dispersion there in the estimates. The next size market or segment is NAV loans to secondaries funds. And then you have NAV loans to other types of funds, GP solutions, and CFOs are a relatively smaller but growing segment. Okay, here, for those not as familiar, I have just a quick overview of how a fund is structured and how some of these facilities fit within the fund. So what we have here in the green box in the middle is typical private equity fund. It could be private credit or infra or real estate fund. It's going to make investments. Those are the red boxes below the fund, and it's going to receive commitments from its investors from above those, the blue boxes above the fund. So this is a typical structure for a drawdown style fund. It's different from, let's say, a mutual fund where the manager takes the investor's money and invests it right away. In these funds, the investments happen over time, and investors put money into the fund over time. And so the subscription facility and the NAV facility come in. Those are the boxes in yellow on the right side. NAV facility can be provided either to the fund or to an SPV below the fund, backed by just a subset of the fund's investments. Okay, so now to get into the specific products in greater detail. Let's start with subscription facilities. These are kind of the plain vanilla bread and butter segment of fund finance. As I mentioned, subscription facilities are revolving liquidity lines provided to these private capital, private equity funds. They tend to have relatively short terms, maybe a year or two, sometimes longer. And their purpose is to provide bridge liquidity for the fund manager. As the fund identifies investments, it will draw on the facility to make the investments. It will do that a number of times, and then it will call capital from its investors to pay down the facility, and then do that all over again. This improves operational efficiency, both for the fund manager as well as for the investor. They both don't have to deal with as many capital calls as historically, or as many as you would without the facility. It also improves IRR for the fund because it delays making capital calls on investors. What are the key rating drivers, and how do we look at them? So really, these facilities are backed by the commitments of the investors to meet their capital calls. And so really the quality of the facilities primarily relies on the quality of the investors. We see some funds, particularly the larger funds, they'll have very diversified investor bases. It could be 300, 400, 500 investors, mostly institutional and fairly high quality. We also see smaller investor bases for smaller funds. For example, it could be 20 investors, mostly family offices. And so the quality and diversification varies greatly. The facility has an advance rate against the unfunded commitments of the investors. We see that typically ranging from the 60 to 70%. So there's a good amount of credit enhancement there as well. And then we also take into account qualitative factors. For example, the quality of the fund manager. Can they run their operations well? Do they have a strong franchise? Are they successful raising money? We look at the documentation of the fund and, for example, default remediation provisions. This means that if a particular investor did not meet their obligation to meet a capital call, the fund manager will often have the ability to take the fund's stake from that investor and sell it to a different investor at a discount. This incentivizes the original investor to continue meeting their capital calls and also incentivizes new investors to come in if needed. Those are key factors. And then, of course, you have the quality of the investments of the fund and things like that. Okay, growth drivers for this segment. Really, as I said, these facilities are fairly standard. And so as new funds are raised, they will typically put in place a subscription facility. So the growth of this market is driven to some degree by fundraising. There are more funds raised with bigger fund sizes. The subscription facility will be sized relative to the overall size of the fund. And so the bigger the funds and the more funds there are, there'll be more demand for subscription facilities. These facilities also renew over time. So even existing funds further later on in their life will still have a subscription facility in place, but it may be smaller because they're not making as many investments as early on. So this is the first product. Second product, and so I forgot to mention that please feel free to submit questions through the Q&A button. I'll address some of them perhaps as we go along, and I'll leave some time at the end to address some additional questions. So for now, NAV facilities. So NAV facility is essentially a loan, usually a term facility. We see most typically 5 years, but could be more or less than that. And the loan is backed by the assets of the fund, and there are different segments within that based on the different types of funds. So you could have a buyout fund that will have a relatively concentrated portfolio of a few equity control investments. You can have a credit fund with dozens of underlying loans. You can have a real estate fund or a secondaries fund. Secondaries fund buys other funds, and these are generally the most diversified. And the NAV loans will be repaid based on the cash flow coming in from the assets. So it's essentially asset-based finance. And so for us, analyzing the assets and the cash flow profile of these assets, how much cash flow they're going to generate, is the key driver of the analysis. When we look at these, we look at the portfolio of the fund, the assets that the fund has. We at Fitch initially really are focused on secondaries funds, given their diversification and given we have existing models and we're quite familiar with these types of portfolios. We are expanding our methodology to cover buyout funds and credit funds as well. But for now, my focus will be on secondaries funds. So, for example, a secondaries fund might have 200 investments in other funds. Each of those funds will have multiple investments. So on a look-through basis, could be hundreds or thousands of positions, mostly equity positions, across this portfolio. For this reason, the loan-to-value or LTV of NAV loans to secondaries funds can be relatively higher. It can range from 30% to around 50%, a little bit more. That compares to only maybe around 10 or 15% typically for a buyout fund because of the higher degree of concentration. Importantly, we do bottoms-up cash flow analysis for these facilities. So we will look at the assets of the fund, we'll model cash flow that comes out of those assets, and then we'll put it through the structure of the facility. It has LTV triggers, amortization schedule, etc. We'll incorporate all of that. And then there's also a qualitative overlay taking into account the quality of the manager. And the manager is important. We see in these facilities, they're quite bespoke, and there's often some level of reliance on the manager, some leeway provided to the manager that the loan might not amortize all the way through maturity, but the manager will put some excess cash beyond the required amounts to pay down a facility, or the manager may call capital from its investors to pay down a facility. So there is some level of optionality in some of these facilities. Collateralized fund obligations, CFOs. What are these? So this is actually not a totally new product. We at Fitch actually rated CFOs. We rated our first CFO in 2004 and early 2000s. We've seen them go through a number of downturns, including 2008 and 2020. There are two types of CFOs, an LP CFO and a GP CFO. So LPs are the investors in the fund. It could be a sovereign wealth fund or an insurance company or pension. They have accumulated investments in various private capital funds, private equity, growth, and infra. They need to generate, for example, liquidity out of their holdings. And these funds, they generally don't have redemption options. So options for liquidity include either wait for cash flow to come in from the fund. You can sell the fund in the secondary market, or, for example, a CFO is another option. So an investor might take, let's say, 30 of their fund interests in different buyout funds, move them into an SPV. The SPV will then issue debt and equity tranches. Often, the original investor will keep the equity because they want to maintain exposure to this portfolio, and the debt will be sold to typical capital markets investors who buy other structured finance instruments like CLO notes or aircraft securitizations. And the notes will get paid as cash flow comes in from the underlying funds. Now, depending on the types of funds, let's say if it's most typically buyout funds, cash flows from these funds are not contractual. And so there's a degree of estimation that needs to be made relative to, for example, securitizations of debt instruments that have contractual repayment mechanics and interest payments. A GP CFO is a CFO that a fund manager will structure and allocate, essentially have the CFO invest in multiple of the manager's funds. Let's say you're a fund manager and you're raising money for 5 or 10 different funds, buyout funds, real estate funds, infrastructure funds, credit funds. The CFO will become an investor in each of these funds. When these funds call capital, the CFO will call capital from its investors, pass that money down, and then as the underlying funds distribute capital, the CFO will take that money and it will go down the priority of payments. So paying interest on the notes first, then amortization if relevant, and then the remaining will go to the equity of the CFO. Analyzing CFOs is quite complex. Fitch has a proprietary model that we developed, private funds model. It looks at each fund in the portfolio, and we project cash flow curve for this type of fund through different types of cycles. Interesting point, as I mentioned, cash flows from many of these funds are not contractual and can vary materially. For example, 2021, it's a very good year. Market activity was very high, and we've seen a lot of exit activity. That meant that buyout funds received a lot of distributions, which they passed to their investors. On the other hand, the last few years have actually been a relatively weaker market environment, as I mentioned, and so funds receive much fewer distributions. And so even the same type of fund, let's say you have a 5-year-old buyout fund, that type of fund would receive maybe 25% or 30 or 35% of its value in distributions in a particular year, in a very good year, like 2021 or 2005. But in a bad year, weaker year, it might only receive 10% of the value of the fund in distribution and cash flow. So the variability is high. We then stress these cash flow curves further for higher rating stresses. So for BBB and a single A rating stress, the CFO notes would need to be able to get repaid under more severe stresses than we've seen historically. So we'll run all of our cash flow curves through downturns like 2008, 2020, and then stress them further. The results will be driven by the diversification of the funds, the vintages, the strategies. So for example, venture funds obviously will be more volatile, produce less cash than buyout fund, or senior direct lending fund will have more steady distributions than a mezzanine fund. Liquidity is also very important in these transactions, and we generally see liquidity facilities or reserve accounts built into these transactions because if we go into a down market and distributions slow down, the vehicle still needs to pay interest on its notes, needs to meet capital calls from the underlying funds. So this kind of liquidity is paramount. Growth drivers. What will drive growth in CFOs? It's investors' liquidity needs. So in an environment like today, we are actually seeing more CFO activity. It's picking up as well. Investors are looking for liquidity. They're not necessarily all interested in selling their fund interest into the secondary market. Often that requires taking a discount on the sale. And so if investors can generate partial liquidity through CFOs or even a NAV loan, they might do that. As I mentioned, the GP CFOs, the growth in those will be driven by the fundraising needs of the fund managers. Market conditions are also important because this is a funding vehicle, particularly for existing investors. If interest rates are lower, it's more likely that we'll see more CFOs because the ability to fund them is going to be easier. And then the last product I'll cover are rated note feeders. And just a reminder, I received a couple of questions here. I'll leave a few minutes in the end to answer these. But just to cover off rated note feeders. So if a rated feeder is essentially like a CFO, and sometimes they are interchangeable. what we think of CFOs as kind of the more traditional vehicle, but a rated feeder essentially is a CFO into just one fund. So if the CFO historically has been a SPV that invests or has stakes in multiple funds, usually many, again, 30, 50, could be 100 funds. Rated feeder more typically has a stake in one fund. And why are rated feeders used? So rated feeders are much more clearly a fundraising vehicle, originally set up for insurance companies to improve their capital efficiency that they receive investing in funds. For example, let's say an insurance company invests in a private credit fund. That investment's traditionally in the US under insurance rules will count as an equity investment and receive equity capital charges, which are relatively high. If rated feeder is set up the way it would work, the feeder will invest in the private credit fund. The rated feeder or the SPV will issue debt and equity tranches. The investor, that's an insurance company, will buy both of these tranches and can receive more or less similar economic exposure to the fund. However, because it is doing it through a rated debt tranche and an equity tranche, the capital charge might be different in total. The insurance company might also place the various tranches with different affiliates. Some of these might prefer an equity investment, some would prefer a debt investment. But what I described is kind of a more traditional vertical participation, where the same investor buys both debt and equity tranches. We are also seeing now this market developing further, and you have more horizontal participations where different investors will buy the debt tranches and the equity tranches. For example, a family office or a high net worth individual might be interested in leveraged exposure to a fund. They might buy the equity tranche, while again, an insurance company or an asset manager or pension fund might be interested in just the debt tranche simply as a relative value structured investment. One question we received is on the typical equity slice in a CFO. So we see, I mean, that can vary quite a bit. We have some CFOs where the sponsor looks to receive as much liquidity as possible. And so most typically these will be structured as 50% single senior note, maybe another 15% mezz, and another 5 or 10% junior tranche. So that would imply about 25 or 30% equity tranche. In other cases, the sponsor looks for just a modest amount of liquidity or leverage. They might put together only 40 or 50% LTV senior tranche. That would imply 50 or 60% equity tranche. So there's a lot more variability here than, let's say, more traditional structured finance. Question also included a comparison to NAV loans, and I think that's fair. So NAV loans can look very similar to CFOs. There are some differences. So CFOs will typically have fewer covenants, they'll have longer maturities, and higher LTVs. NAV loans will have shorter maturities, more covenants, and lower LTVs. But these are bank provided, and so there are specific considerations for the lenders in a CFO versus a NAV loan. Okay, we received a question on monitoring the various ratings. I mean, the monitoring is quite different across all of these, of course. So, for example, we receive generally quarterly information on the performance of the funds, the waterfalls, etc., distributions, cash flows. So, for subscription facilities, we look at the composition of the investor base. That's generally not going to change that much. There are, of course, trades in the secondary market, but there's quite a bit of cushion in the advance rate typically. That's not going to change. Also, banks are providing the subscription facilities. They control whether they accept new investors into the borrowing base. So even if there is a trade, the bank might exclude the new investor from the borrowing base. For CFOs and NAV loans, we receive quarterly cash flow information to see how much cash flow the underlying funds distributed, how the LTV of the structure has evolved over time. And pretty much all of these deals are structured with step down LTVs, or the LTVs are meant to step down over time through amortization. We are seeing some more sweep holidays now, where there might be a year or two where no distributions are swept to the loan or the note, as long as certain thresholds are met. For example, as long as you meet the LTV trigger and you're not above it, all the money can leak out to the equity. So these are obviously naturally kind of weaker structures. There are some mitigants that can be put in place, for example, longer maturity or further step down amortization. Otherwise, all else equal, from our perspective, these types of structure might receive lower ratings. See the question on the historical performance of some of these vehicles. So historical performance has actually been very, very strong, particularly for subscription facilities. As I mentioned, these have been around since the 90s. There have been thousands of funds with thousands of facilities out there. As far as we are aware, and the industry, folks in the industry are aware, there have only been 2 instances of default on subscription facilities. In both cases, they are related to fraud by the manager. And these were kind of instances in the last 10 years or so, 8 years. And so that's why reviewing the manager is an important qualitative consideration, both for us and for the lenders, but generally very strong performance there. NAV loans, NAV loans, I would really have to distinguish between the different types of segments. So secondaries NAV, again, I'm not aware of any defaults going back historically about 20 years. I am aware of some more, again, they're fairly isolated, but some issues with NAV loans to real estate funds or NAV loans to certain very concentrated and smaller buyout funds. So we see the risk there as where there's more sector or asset concentration is where we can really start seeing some trouble. And I think we're just about at time. So we'll try to address some of the questions that we received afterwards offline, and please feel free to reach out if you have additional questions or would like to discuss directly. Thank you for joining.